Okay, let's start with the punchline. Back in July, the people who unwound their leverage, cleared out their margin accounts, and said, "This is it, the correction is coming," they're buying back in right now. And fast. The Nasdaq 100 shot up to the 718 level in just days. IGV, the software and cybersecurity ETF, blew straight through its 200-day moving average and hit 101. Let's put a real number on this. Say you were sitting on a $50,000 portfolio, half of it in leveraged tech exposure. In about 3 weeks, you watched it drop close to 12%. That's roughly $6,000. Gone, on paper, in less time than it takes to finish a Netflix season. And if any part of that was margin, your broker didn't ask you nicely. It just sold. Was that you? Early August, staring at the news, laughing at yourself because, wait, did I actually sell the bottom? If that's you watching this right now, yeah, I see you. Don't worry, you're not the only one. Thousands of people did the exact same math on the exact same week for the exact same reason. And here's the thing that's actually funny. This isn't random. It's not bad luck, and it's not that you're bad at investing. There's a real, repeatable mechanism behind it. And once you see it, you'll never watch a sell-off the same way again. I'm going to walk you through every piece of it. Why does this video matter to you? If you don't understand where money is actually moving right now, where it's coming from, and where it's going, you're going to get burned the exact same way again. Sell at the bottom, buy back in at the top, rinse, and repeat. But if you actually understand this flow once, properly, next time you're the one taking advantage of the panic instead of causing it. My name is Moon. I genuinely obsess, over tracking where money moves and why. If you've ever felt like you're always a step behind, always catching the wrong side of the timing, hit subscribe. And if this video helps, drop a like. It'll actually help you. All right, let's look at what actually happened in July. Retail investors had loaded up on leveraged ETFs and margin debt. Then the market wobbled, just a little, and that leverage came back like a boomerang. Margin calls, forced liquidations, panic selling. Money moved out of stocks and into cash, and it moved fast. Here's the key part, though. This wasn't selling because the market broke. It was selling because of leverage structure. It had nothing to do with fundamentals. It was forced mechanical selling that had to happen regardless of what anyone actually believed about the companies involved. And now, the technical deleveraging is basically done. The people who had to sell have already sold. What's left is a market where leverage is starting to come back in, and it's flowing into cash and into stocks again, specifically into Nasdaq names and the software sector. Here's what most people never realize. This deleveraging cycle usually ends right at the moment it feels the scariest. The point where everyone wants to get out is almost always the same point where the selling pressure is running out of fuel. Here's what people usually believe. If the index jumps this fast, this hard, it's unstable, it's going to crash right back down. That's not entirely wrong as a general rule, but it doesn't fit what's happening right now, because this rally isn't being driven by new money flooding in. It's being driven by forced sold money returning to where it came from. That distinction matters a lot. A rally built on fresh inflows can get overheated fast. A rebound built on exhausted forced selling is often the launchpad for the next leg up, not the top of one. This is where it gets genuinely interesting. The ISM Manufacturing Employment Index just entered expansion territory for the first time in 33 months. 33 months. Almost 3 years. And right now, companies are hiring more than they're laying off. Here's why that matters. When a market drops fast and then rips back up just as fast, the number one fear people have is, wait, is the economy actually breaking down? But when the employment data just turned expansionary after nearly 3 years, that tells you the underlying economy is a lot more solid than the panic narrative suggested. The recession fear that drove the sell-off, the data, is now pointing the opposite direction. So who's driving this rebound? This is the part that really matters. Big tech's infrastructure and AI-related Capex spending hasn't slowed down at all. If anything, it's still climbing. These companies aren't retail traders getting margin called. They're operating on multi-year spending plans that don't flinch because of a 2-week wobble. And here's the piece that ties it all together. Mid-August through mid-September is buyback season. That's the window when major companies execute their share repurchase programs, literally buying their own stock. Once that kicks in, it creates steady, sustained buying pressure in the market. Let me put that in perspective. Companies in the S&P 500 have been buying back stock at a pace of tens of billions of dollars a month in recent quarters. Think about what that actually means. Mechanically, that's a buyer that shows up in size week after week, completely indifferent to headlines, completely indifferent to fear. A buyer like that doesn't panic sell on a Tuesday because of a scary tweet. It just keeps executing the plan. And this isn't the first time we've seen this exact sequence play out. Go back and look at past cycles. A sharp, leverage-driven flush lower, followed almost immediately by a buyback-fueled floor underneath the market. It's happened enough times that it's less coincidence and more pattern. The forced sellers clear out first. The disciplined buyers show up right after. That's not a prediction of what always happens, but it's the same setup we're looking at again right now. So here's the full picture. Retail investors, unwinding leverage, selling out, driven by fear. Corporations, Capex untouched, buybacks about to ramp up, driven by a spreadsheet and a calendar. Two completely different decision-making processes running on two completely different timelines. And right now, money is rotating away from the panicked individuals and toward the institutions and corporations that never panicked in the first place. So why do people always seem to get this exact moment wrong? It's psychology. Your brain is wired to feel losses far more intensely than they actually deserve. So when your account turns red, the instinct that fires first isn't rational analysis, it's make this pain stop. And if it's a leveraged account, it's worse, because a margin call isn't even a choice. It's forced. So ironically, people end up selling at the exact moment that's most emotionally unbearable, which is almost never the moment that's most logically correct. And by the time the selling is actually finished and the market turns, they're the last ones chasing it back in. You're probably thinking this right now. Moon, it already hit 718. It already blew through the 200-day. If I buy now, aren't I just catching the top? Fair concern. But look at what we're actually watching here. This isn't the start of a new bubble. It's forced sold positions normalizing back to where they should be. And right behind that normalization is a buyback season that's already scheduled, with real buying pressure lined up over the next month. To be clear, this is my own read on it, and markets always have variables that can shift things. But at minimum, buying into this right now is a completely different decision than blindly chasing a random breakout with no reasoning behind it. So, concretely, what should you be watching? First, keep an eye on margin debt levels and leveraged ETF flows. If those numbers start climbing again, that's your signal the market's reloading on risk. Second, track buyback announcement schedules. Between mid-August and mid-September, watching which major companies announce repurchase programs gives you a preview of where the buying pressure is going to concentrate. Third, don't go all in on this in one shot. Don't chase it out of fear of missing out because you missed the initial move. Understand the flow, then approach it in stages deliberately. Honestly, the scariest thing in the market was never the drop itself. Drops always happen, and they always will. What's actually dangerous is going through that drop without understanding why it happened, selling on emotion, then buying back in on emotion over and over. If you stay stuck in that loop, the market will never work in your favor. Remember that $6,000 hit we talked about at the start? The person who understood what was actually happening, who knew it was forced, mechanical selling, not a broken economy, didn't just survive that moment. They were positioned to be on the other side of it, buying into the same fear that shook everyone else out. Same market, same 3 weeks, two completely different outcomes. That gap is what this channel is about closing. Like everything you saw today, there's always a reason behind the numbers. Learning to read that reason is what turns you from the person who panic sells into the person who catches the opportunity. It's not about being smarter than everyone else. It's about not being the one who has to sell. I'll keep digging into flows like this and bringing them to you, so hit subscribe, and if this helped, drop a like. Protect and grow what you've built.